2023 was a tale of four quarters, or more precisely, a tale of the first three quarters and then the fourth quarter. Hi, I'm Paul Delaney, a wealth advisor with Capital Insurance Group. I'm going to discuss some of our observations about key indicators in the capital markets as we move into the first quarter of 2024. In the first three quarters of 2023, although we didn't fall into recession as most Wall Street forecasters expected, the S&P 500 on an equal weight basis was up only 1.69%. That's the purple line here. So it was in fact a fairly inhospitable environment for many companies. Of course, we wouldn't have known that looking at the normal market cap weighted S&P 500 index, the orange line here, because it was the so-called Magnificent Seven large cap US tech stocks that dragged the entire index higher, starting around April with all the excitement around AI. And then we got the fourth quarter so-called everything rally as the market became comfortable that the danger of further rate hikes by the Fed had been taken off the table. You can see that here where the equal weighted index kept pace with the market cap weighted index in the final quarter of 2023. This burst of optimism was reinforced by the Fed chairman's December 13th speech outlining 3 expected rate cuts in 2024. After so much bearishness in 2023, we now find ourselves in a market that seems to be almost too bullish. This is the Bulls minus Bears Sentiment Index, and at 24% it's near extreme bullishness. History shows the S&P 500 is vulnerable to a correction now. In this chart I've drawn a blue horizontal line to show peak bullishness and then black arrows showing what happened after we hit peak bullishness. Valuation also appears rich. The S&P 500 is trading at a PE of around 21 times this year's earnings, which is towards the upper end of the typical valuation range. Part of why stocks are trading at a high multiple of earnings is that investors expect the real rate of interest to come down in 2024. The real rate of interest is just the nominal yield on bonds less expected inflation. In this chart we show the 10-year Treasury real rate of interest against the S&P 500's book-to-price multiple. The book-to-price multiple is simply the inverse of the price-to-book valuation multiple. The book-to-price and real rate should broadly move in lockstep over the long term. You'll see that from 2009 the Fed engineered a massive decline in the real rate of interest from about 2.5% all the way down to minus 0.75% in 2012. That's the blue line here. The lower real rate helps spur economic growth, boost corporate earnings, and increase the value of companies, and vice versa. In the post-COVID period, you'll notice a massive spike in the real interest rate as the Fed hiked interest rates aggressively to combat inflation. And you'll also notice that the book-to-price orange line has not moved up in lockstep. That is, stock valuations remain elevated given where real interest rates are. We now have a large divergence between these lines highlighted by the black arrow, and history tells us that they should come back together through falling interest rates, a decline in the valuation of stocks, or a mix of both. Investors are expecting the Fed to cut interest rates aggressively in 2024 to support the economy and stock prices. If the Fed doesn't deliver this, or if inflation makes a comeback, then a correction is likely. If US interest rates are poised to fall substantially, the trade-weighted US dollar is likely to decline somewhat too, as you can see from this chart that is focused on emerging market currencies going back to 2007. That could be a good setup for emerging markets. We're already finding opportunities there, and it could be good for numerous other areas such as commodities, energy, and Bitcoin. This chart from Fidelity illustrates how asset classes often under or overperform each other over long periods, often 10 to 15 years. Could the return dominance of large US growth companies be coming to an end compared to non-US companies, commodities, or small cap firms? This chart certainly suggests it could be, and that should be encouraging to all retirement investors. It illustrates that there is always investment opportunity. We just have to be paying attention to find where that opportunity is and invest accordingly. Speaking of small cap stocks, here is how badly they perform versus their large cap peers. This chart shows how they remain 4.69% below where they were 3 years ago, while microcaps have fared even worse. down 11.98%. We're fortunate to have been out of this part of the equity market and focused on large US companies for quite some time now. Smaller US companies have not fared well because about 40% are structurally unprofitable. They're more dependent on banks for what is now very expensive funding, and they've lost the war for talent against larger firms. US bonds are a key area to watch with implications for all markets. They've been extremely volatile as investors have tried to figure out whether inflation has been beaten and if and by how much the Fed will be able to lower interest rates. As you can see from the blue line on this chart, longer term bonds have been hugely volatile, while even the total bond market proxy called the AG, in orange here, has had stomach churning ups and downs for a diversified bond fund. We've added some exposure to medium-term bonds given we think the Fed will eventually ease short-term rates, but the extent to which longer-term rates can fall remains unknown. Many factors could hamper disinflation and rate cuts, such as a still fairly tight labour market, higher real wages, ongoing bombing of cargo ships in the Red Sea, and a massive federal budget deficit that needs funding by investors. This is a more turbulent bond market than we're accustomed to, so we intend to be patient, knowing that we're offered a near risk-free 6% yield on short-term bonds with much less volatility than the rest of the bond market. So as we look ahead, the equity market is discounting Fed rate cuts, but no recession. If the Fed can pull off that rare balancing act, we may find that other asset classes supplant the Magnificent Seven as the leading return generators. If the Fed can't pull off the soft landing scenario, then we may be in for some temporary stock price pain. It seems probable that the Fed will be able to lower interest rates, but by how much really depends on how inflation tracks. At Capital Endurance Group, we're invested in what's working while avoiding what isn't. As always, thanks for watching. See you next time.